So this is May Valensky with Driving Markets. Why did the market fall on Friday when the employment numbers, the non-farm payrolls, came out higher than expected? Well, the non-farm payrolls is the main measure of employment in the US, and it comes out on the first Friday of each month. Just so happened for January came out with the second Friday due to the new year falling on that midweek. Doesn't really matter. Let's get into the details. So the markets were expecting 163,000 jobs created, and there were 256,000 jobs created. When normally you would say that as a good sign. It shows that it's a robust economy, that you've got people that are buying, you've got spending, you've got earnings that are going to be impacted upwards, and overall it means that people are going to have more money to spend. But why did markets go down, and why did bond yields go above 5%? Or the 10-year bond yields went above 5%. Well, the reason behind all of this is simply the outlook for falling interest rates in the US. If you go back to November 2023, when Jerome Powell came out with that famous statement that they're going to reduce interest rates by at least 3 times in 2024, irrespective of market conditions, and that sent stock markets flying. So the stock markets built into the whole mechanism, built into the price that interest rates would fall throughout 2024. And they didn't. And then they said, okay, rates are going to fall in 2025. Now there's less chance of a 1 or 2 times interest rate drop in 2025 as a result of a robust employment market. So what you have, quite simply, is that markets have priced in lower interest rates. They're not going to get lower interest rates, and Jerome Powell and his fellow colleagues on the Fed and the central bank are now in a dilemma. They want to reduce interest rates to get the economy going. They can't reduce interest rates because inflation is still sticky and still high, and yet they know that a recession is coming. Now, if they do reduce interest rates, inflation will move even higher. So they've got themselves into a very, very sticky position. What do? Well, bond traders, if you look at bond traders, the bond market is now not happy with Trump's policies. They think that the proposal for tariffs, the taking over of Canada as the 51st state, and the invasion of Greenland, which are it's not going to happen, but these are just erratic statements made by Donald Trump, have frightened bond traders and pushed yields up. With rising yields, you now have falling financial markets. And that's why markets have fallen, mainly because bond yields have gone up on the outlook of no interest rate reductions in 2025. Catch you later.